Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. One of the best ways for companies to return money to shareholders is actually to buy back stock. That reduces the amount of stock that's outstanding. It means you own a larger and larger percentage of a company over time, even if you're not buying any more shares. And there are 4 companies that have been buying back stock, consistently reducing their share count, that I think could still be a really great value for investors. That's what I want to dig into today. My name is Travis William. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And if you like this video, check out my newsletter, Asymmetric Investing. I have a link to that in the show notes. And I want to start with a company that you probably are aware of, but maybe aren't aware of how quickly they're buying back stock, and that's Dropbox. This is a chart of Dropbox's shares outstanding over the last 3 years. And you can see that in March 2021, the company had 415 million shares outstanding. As of today, that's down to 348 million. So buying back over 65 million shares of stock over that period of time. Now, Dropbox is not a super high growth company, but you may be surprised at how steadily the company is growing, churning out cash flow. And one of the ways that it adds value to shareholders is it buys back stock on a regular basis. That helps grow earnings per share. And as long as the stock remains as cheap as it is, I think they'll continue to buy back stock, and that should help push the value of each share higher as well. Another company that has been buying back stock at a really rapid rate is Fox. In the last 3 years, Fox has gone from having 605 million shares outstanding to just 409 million shares outstanding. And this is as the company really focuses just on being a sports and news content creator. It's one of the companies that has not pursued a business in streaming. It's primarily just selling its rights to cable operators and other streaming companies. So one of the more focused companies. And so as a lot of the media landscape has challenges trying to generate cash flow, Fox has actually done relatively well and has used a lot of that money to just buy back shares over time. Another company that has been buying back stock like crazy is Lowe's. And this is actually a long-term trend for Lowe's. 756 million shares outstanding in October 2020, now 582 million shares outstanding. If we zoom back even further, you can see that Lowe's has been doing this for decades. That's a 10-year chart. This is a 20-year chart. So if we go back to 2006, there were 1.6 billion shares outstanding, now only 582 million. So bought back well over half of the outstanding shares of the company. And like I said, that just adds value to shareholders over the long term. AutoNation is another company that is on a similar trend. And now that it is a value stock, you can see that the trajectory of their buybacks has really increased over the last few years. But let's go back 20 years. The company had 275 million shares outstanding. That is down to 44 million shares outstanding today. I'm going to pull up the 3-year chart right here. You can see that over the last 3 years, the company has bought back nearly half of its stock in just 3 years. So a really rapid pace of buybacks for AutoNation. Again, this is one of these companies that's trading at a really good value right now. And that's one of the reasons that management has been so aggressive in buying back stock. Buybacks can be a great way to return money to shareholders, especially if a stock is trading at a deep discount. So if a stock is trading for a low price to earnings multiple, that means that management is buying back stock at a relatively low price. It's actually going to increase the earnings per share faster than if they're buying back the stock at a higher price to earnings multiple. So this can be a great way to grow earnings per share. And as long as the core business is solid, we'd like to see revenue growth. We'd like to see free cash flow growth. As long as that's all in place, as long as management is buying back the stock at a reasonable price and is doing it consistently over time, basically dollar cost averaging, this can be a great way to add value to shareholders. These are 4 companies that have just been buying back shares like crazy, not only over the last few years, like Dropbox and Fox, but we go to companies like Lowe's and AutoNation, and this is a trend that they've been using for decades. So if you're not keeping an eye on buybacks and the amount of shares outstanding falling over time, I think that's something to put on your radar because it's a much more bullish signal than you might think. But what do you think about these? Were you aware of the falling shares outstanding in all 4 of these companies? Leave your comments in the comments section below. Don't forget to subscribe to Asymmetric Investing. And thanks for watching, everybody. See you here next time.